Well, Happy New Year, one and all. It's a delight to be with you again. Tom Dixon here, your host and chief organizer for the Financial Experts Network webinar series. How's that for a mouthful? You know, I've been researching, getting ready for this session for the last 2 weeks or so, everything and anything about student loans, and I will sum it up this way. It's complicated. It's complicated, right? And yet, there are how many 40 million plus people that have student loans, and I don't know that everyone truly understands all the options available to them. And that's really our focus today, in particular for anyone that is really struggling with student loans, and given the fact that the relief measures are going to expire short of any other legislative changes in the coming weeks, the relief that came about through the CARES Act is due to expire at the end of this month. So said another way, that means for anyone that has a federal student loan that was lucky enough to have that relief will go away as of February 1st. Your payments will start, or your requirement to make that payment will start once again. So in that context, I'm really delighted to have both Heather and Larry here to, again, walk through in a very detailed way what's available to any student loan borrower. In particular, we're going to focus on the income-driven repayment plans. And again, I'll confess, until I really engaged with Heather at the beginning of last year, when Heather first did a webinar for us, not that it was that important, not that it was that fantastic. It was on May 27th of 2020. How's that for memorable? Knocked it out of the park, was the highest rated speaker I've ever had on my webinar series of doing this for over 11 years. I just hope she doesn't get a big head about it, but I'm just so delighted to have her back. Literally a couple decades of focus on the area of student loan, heart in the right place, public interest law, geez, what's not to like, and so delighted to have her back. So Heather, thank you so much. Of course, delighted to have my longtime friend Larry Kotlikoff join us, one of the top economists in the world. Not everybody can say that, I think, and just a student of everything. And I think, you know, it's interesting, Larry has been studying up again on this issue, not that he wasn't familiar with it, but I think has really been intrigued by it as well, and has been kind enough to agree to join us today and to really walk through some interesting case studies or client scenarios for what these various repayment plans mean. So there you have it with a little bit about our experts. Now, let me just walk through a few housekeeping matters before I hand it over to Heather, who's going to kick it off. If you're not following financialexpertsnetwork.com, make that part of your bucket list for 2021, because that's where we will post everything and anything about upcoming webinars, replays for sessions like today, blog posts that we're going to put out post this session today, really summarizing some of the highlights that Heather and Larry walked through today. So again, all on the website. Of course, you should link to me on LinkedIn.com, because I post a lot of those notices on LinkedIn as well. So you can make sure that you catch it in one of two places. It's my pleasure to hand it over to Heather. And Heather, I made you the presenter, and I can see your screen. So all yours, and thanks once again. And I'm going to go off screen.
Thank you, Tom. Thank you for that warm introduction. I appreciate it very much. And I'm always happy to talk about student loans, particularly income-driven repayment, which is a very important feature of federal student loans. So as Tom said, the CARES Act provisions have expired. The administration has extended the payment suspension for federally held student loans through the end of January. I think it's likely that the incoming administration will further extend that payment suspension. That's not a done deal yet, but in my view, it would be surprising if it were not extended at least through the end of March. I think it's also possible that it could go longer than that. So that said, sooner or later, payments are going to be due again. And when payments are due, federal student loan borrowers have many repayment plans to choose from. They also have access to temporary postponements of their obligation to pay. There are deferments and forbearances available for borrowers. And the difference being only that a forbearance is a period in which interest continues to accrue on all student loans, including those that would otherwise be subsidized. Subsidy meaning that the government pays the interest during certain periods of deferment. So deferment is a better option than forbearance, but forbearance is also available. And even more useful for most borrowers are these income-driven repayment options. So to begin, let's just take a very brief look at the kind of plans that aren't income-driven. So many of us are accustomed to terms of repayment that include a specific length of time. For example, 10 years. The so-called standard repayment term for student loans is 10 years, but can be as long as 30 years for a consolidation loan if the balance is $60,000 or more. There are also graduated and extended plans available for borrowers. Those are much, much less advantageous than the income-driven plans in most instances. So that's one of the reasons why when Tom said, let's focus on the differences between income-driven plans, I said, yay, I love that, let's do it. So little tiny history about the way these plans developed so that you can keep it all straight. Income contingent was the first of the income-driven plans. And when I say income driven, I mean that to be an umbrella term that encompasses all of the repayment options that calculate monthly payments by looking at a borrower's income. So the plans have been developed since the mid-90s. This is all controlled by the Higher Education Act. And so the plans have been changed by Congress and various administrations for a long number of years. And that's why they continue to introduce new plans with tweaks, with the idea being that they'll improve over time in their targeting. And we have seen that to a degree. So let me just move along here. So the income-driven repayment plans, the main way they're different than normal repayment is that they look at adjusted gross income, family size, and the federal poverty rate that corresponds with the borrower's family size. And these are the only factors that influence the payment amount. So notably, the balance and the interest rate are not what determine the payment amount under these plans, which is what makes for a lot of confusion. Another reason that the income-driven plans are extremely important is that the two primary paths to loan forgiveness within the federal student loan system are linked to the selection of an income-driven repayment plan. Both public service loan forgiveness, as well as the long-term income-driven forgivenesses, are associated with the selection of one of these plans. So to summarize, borrowers who are working in public service jobs may be able to make income-driven payments over 120 months or 10 years and earn forgiveness of student loans. People who are not in public service positions may be able to choose an income-driven plan and make payments for a long time, 20 or 25 years, depending on the plan, after which point they will earn forgiveness or cancellation of any remaining principal and interest. That long-term income-driven forgiveness is taxable as income to the borrower in the year in which he or she receives that forgiveness. So income-driven repayment plans are useful for making monthly payments affordable, and they are also the primary tool for reaching some kind of loan forgiveness to the extent that that's available for a given borrower. So the way these plans work is they look at the poverty guidelines that correspond with a borrower's family size. So I have a 5-person family, I'm married, and I have 3 children. And so a 5-person family size, the federal poverty rate is a little more than 30 grand. They take 150% of that amount in most cases, which in this case would be 46,000 in some. And that first amount that's earned is insulated, and no portion of it is required to be sent to the student loans. It's the amount of income that a borrower has over and above 150% typically of the federal poverty rate that is considered discretionary. And of that discretionary income, a percentage of it is required as a student loan payment. Okay, so this will all become more clear as we compare these plans. So they all have their acronyms: income contingent repayment, ICR, income based repayment in its two versions, old and new, as I like to call them, pay as you earn, and revised pay as you earn. So I've got these visuals where I'm trying to focus your attention on the differences between the plans so that you'll be able to hone in on which plan may be best for a given situation. And all the plans are of use sometimes, but some of them are more likely to be beneficial to a greater number of people. So the first difference that we're going to compare between the plans is the percentage of discretionary income that is required to be sent as a monthly payment. So again, discretionary income is the amount by which the borrower's adjusted gross income exceeds 150% of the federal poverty rate that corresponds with the borrower's family size. So for ICR, the monthly payment is going to be 20% of discretionary income, but under ICR, discretionary income is going to be a higher proportion of a borrower's income. And that's because only 100% of the poverty rate is insulated, whereas under the other plans, 150% of the poverty rate is allowed to be earned before any portion is required to be sent to the student loans. So ICR tends to yield the most expensive monthly payments. The reason we like ICR is because it's the only plan that's available to parent borrowers under the Parent Plus program, and only then after they have consolidated Parent Plus loans into a direct consolidation loan. So ICR has some limited use in the real world. It is not the best income-driven plan for most borrowers, particularly for those who borrowed for their own educations rather than for their children's educations. So the original income-based repayment plan, or old IBR, as I like to call it, sets payments at 15% of discretionary income, whereas the other three newer plans set it at only 10%. So obviously, new income-based repayment, pay as you earn, and repay set monthly payments at a lower amount. So those tend to be preferred in many situations. Now, all the plans except revised pay as you earn allow a borrower to make payments based on his or her individual separate income, even if married. But the way that that borrower has to accomplish this is by choosing to file a separate tax return, even as a married person who may have good reasons to file jointly. So it is valuable that you as advisors or as CPAs be able to recognize that tax filing status, particularly for married people with student loans, is a critical determinative of the income figure that will be used to calculate payments under these plans. So joint or separate income depending on tax filing status, but notably, the revised pay as you earn plan requires payments to be based on joint income in every case of a married borrower. So you can file your tax returns separately all day, and that won't make any difference if you're enrolled in the revised pay as you earn plan. And that developed that way because this was the Education Department's attempt to narrow the benefits to potentially high earning spouses and their partners. So that's how payment amounts are calculated under the different plans. Now we're moving on to talk about payment caps. And after we talk about payment caps, we'll have a little poll here from Tom. But first, let's talk about how the monthly payments are or are not capped. So under all the plans except ICR and revised pay as you earn, there is a monthly payment cap. So there's a maximum amount that can be due under these plans. And the way it's calculated is they take the standard 10-year payment amount that the borrower would have made on a monthly basis if he or she had chosen the standard 10-year plan to begin with. So confusingly, there's two potential balances that are used to do that calculation. That calculation is based either on the balance that the borrower had when they selected the income-driven plan, so the principal balance upon selecting the repayment plan, or the principal balance when the borrower first entered a repayment status, whichever one works out better for the borrower. So when you first graduate from school, you choose a repayment plan, you're going to have a principal balance then that is one thing. And then that principal balance could go up over time if interest accrues and is added to the principal balance, or it could go down over time if principal is repaid. Either one could be the case. So either one of those figures will be what determines the monthly payment cap.
All right, folks, so here we go. Our first polling question, and hopefully you're paying close attention. There is a prize for whoever gets all three of these right. We will have three questions related to what Heather is covering. So, all right, let me post it on the screen, and hopefully, and if you can't see the question, to go to Webinar Corp, it may require you to actually post or minimize the presentation screen, but hopefully you can see it. And the question is, under which IDR plans are payments for married borrowers always based on joint income? So you can hopefully see again the answer options are, the choices are IBR, pay, or repay. And all right, I'm going to give it 10 more seconds. I want to make sure we keep moving. I'm generally going to allow 30 seconds for participation. So again, let's give it 5 more seconds. And we have good participation. Certainly glad to have that. And all right. Okay, I mean, 2 more seconds. I'm going to fib. There we go. All right. So let me just share, if I may, Heather, so you can see this. The most popular answer was, ding, 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 repay, 75%. And that happens to be the correct answer. So Heather, back to you. Thank you.
Thank you. So, so it sounds like everybody was paying close attention then. All right, so there's these different income-driven plans. They set the monthly payments a little bit differently. They calculate income a little bit differently, and then they set payments at a slightly different percentages of discretionary income as defined by the plan. So, as an advisor, one of the first things you want to do, and what I always do when considering these cases, is I look to see which of the income-driven repayment options are available to a given borrower, because not everyone is permitted to choose between every option. And what determines eligibility are several things. It's the type of loan that a person has, generally whether they have an older federal student loan from a program known as Federal Family Education Loans, or FFEL, versus having a direct loan, which are those that have been issued more recently over the last decade by the Department of Education. But also loan type can refer to things like whether it's a loan I borrow directly for myself or on behalf of my dependent children, and the like. So there's more complexity to that that's beyond the scope of today's presentation. But loan type determines eligibility in part. Also, most of the plans have a sort of need-based testing baked in, which is look at the debt-to-income ratio, and we'll talk about that. And then finally, eligibility for the income-driven plans also depends on the borrowing dates of the individual who is selecting between the plans. So I'll show you these things. Oh, and I'll mention, Tom said we have a handout there, which is the income-driven repayment application. I wanted to mention the main reason I include that for you is that there's a very useful table of information within the instructions to the form that summarizes all the things that I'm talking about today. So I've broken information out of those tables in order to focus your attention on the contrasting provisions of the repayment options. But if you want a quick and dirty resource where you can see it all in one spot, that's a really, really good one. These visual aids are good too, but that's even better. So, all right, so as far as loan type or what sorts of loans are eligible, note that only the original income-based repayment plan, or old IBR, is available for those older FFEL loans. So many thousands of borrowers, tens of thousands of borrowers, hundreds, yes, of thousands of borrowers have these FFEL loans. And those loans are eligible only for income-based repayment, which sets payments at a slightly higher amount than many of the other plans do. But that's why the old income-based repayment plan is still very important and useful. The rest of the income-driven plans are only available for direct loans. And some of our other trainings will include things like how to figure out what kind of student loans your clients have and such. Then there is this need-based question. So there's this debt-to-income ratio, and we call this a partial financial hardship. So a partial financial hardship exists when the borrower's required monthly payment under a standard 10-year repayment term is greater than their required monthly payment would be under the income-driven plan. So if I owe $100,000 at a 6% interest rate, you amortize that over 10 years, my required monthly payments are going to be, what, $1,200, something like that? And if my income-driven payment is calculated at less than that, that's how you know I have a partial financial hardship. So this kind of debt-to-income ratio is a required showing for IBR plans and pay-as-you-earn, but not for ICR or revised pay-as-you-earn. So people who have less dramatic debt-to-income ratios can select from ICR and repay, whereas others may be limited in their options. All right, and then the borrowing dates. So this is an interesting feature of these plans. And I want to be clear from the beginning that the borrowing dates I'm referring to here are the dates upon which the borrower first acquired a federal student loan. So this is a borrower-specific requirement, not per loan requirement. So what I'm not saying is that older student loans are eligible for fewer plans. What I'm saying is that people who have some older student loans are only eligible for older plans. So I started borrowing student loans, a million years ago. And so I'm not eligible to choose some of the newer income-driven repayment plans, even if I also have newer loans, or even if I've already paid off my older loans. So for the pay-as-you-earn plan, the borrower must not have had an outstanding balance on a federal student loan as of October 1st, 2007. So they must be a new borrower as of that date. And similarly with new income-based repayment, they have to have no outstanding federal student loan as of July 1st, 2014. So be a new borrower as of that date. And then under pay-as-you-earn, the borrower also has an additional requirement of having received a federal loan sometime after October 1st, 2011. So that essentially means that if someone graduated in the spring of 2011 and stopped borrowing student loans at that time, he or she would not meet this second prong of the pay-as-you-earn eligibility date question. Okay, so that is that. As I mentioned at the beginning, all these plans have a maximum repayment period, which is not the same as amortizing their payment over that period of time. Because recall, the monthly payments are not calculated based on the balance or the interest rate or any particular length of time. Instead, the monthly payments are calculated based on income, family size, and the federal poverty rate. And so, a person could be paying far less each month than even what they owe in interest, potentially, on their student loans. And so These plans have a maximum repayment term, after which point the remaining balance, if any, is canceled and forgiven. But that cancellation, again, is taxable as income to the borrower, which is somewhat less generous than it would otherwise be. Whereas public service loan forgiveness, recall, is not taxable to borrowers. So note that revised pay-as-you-earn is the only plan that has a different maximum repayment term depending on the level of education the borrower was enrolled in when he borrowed. So if you have any graduate loans, any loans for professional school, then repay requires 25 years of payment, otherwise 20 years for undergraduate loans only. And so obviously it is in a borrower's best interest to have a shorter maximum repayment term. So that can help guide decision-making with regard to which plan is best. All right, and here's where we get to the tricky stuff. So hopefully you didn't think we were already there, because we're there now. We weren't there yet. So with student loans, unlike a lot of kinds of debt, people can avoid paying interest as it accrues. You're permitted to owe money on student loans and not keep up with the interest. This happens most normally when borrowers are in school, but it also happens when borrowers are enrolled in income-driven repayment options. You know, like for example, if we have a borrower that owes $100,000 at a 6% interest rate, that means that about $500 of interest is accruing in a given month. So if that borrower has a low enough income, he could be assigned a payment under an income-driven plan of, let's say, $300. So that would be $200 of interest accruing each month that was not being paid. Okay, and so what would happen to that interest that's not being paid? Well, initially it's kept track of in a separate column from the principal balance, which is helpful. So it's not automatically capitalized or added into the principal balance of the loan. It's not immediately subject to additional interest charges. But capitalization can be triggered by different events, including switching repayment plans, but also including having a state where that partial financial hardship no longer exists. So if you recall, someone has to show that their payment under an income-driven plan is less than it would have been under a 10-year plan in order to have a partial financial hardship and choose the plan. But what happens if their income goes up considerably? Well, then they may no longer have that debt-to-income ratio that would establish a partial financial hardship. And that is reevaluated on an annual basis. And if there comes a time when the partial financial hardship is gone, that triggers capitalization of unpaid interest. And so it is useful to know that under some of these plans, there are limitations to capitalization. Under ICR and pay-as-you-earn, the amount of interest that can be added to the principal balance is limited to 10% of the original principal balance. So if you owe 100 grand, they can only capitalize 10,000 in interest. And then after that, the interest is still owed, but it hasn't been added to the principal balance. And the reason we care is because it's the principal that is interest bearing or that will generate more costs to the borrower over time. So ICR and pay-as-you-earn have that limitation. Revised pay-as-you-earn has a different special and potentially quite valuable interest feature in that if you have a period of negative amortization, and negative amortization is a period where monthly payments do not fully cover the accruing interest, like the example I gave of $500 of interest accruing, a $300 payment, $200 of unpaid interest. That's called negative amortization, meaning the balance is going up instead of down. And so under repay and repay only, the borrower in negative amortization is only charged 50% of the unpaid interest. So in our example, $500 of interest, $300 of payment, $200 of unpaid interest. Under repay and repay only, that borrower would only be charged $100 that month instead of the $200. So repay can be super useful at keeping interest accrual down during periods of lower earning in the repayment period. So repay can be super generous in that regard, but it has other downsides, right? As we noted. And so what all of this amounts to, and I do want to summarize it because I know it's a lot to take in all at once, but the gist of it is that if a student or a borrower qualifies to choose that pay as you earn plan, so if they don't have loans that are too old, or they do have a loan that's new enough, if they qualify for pay as you earn, then the decision making should be generally between pay as you earn and revised pay as you earn. One or the other is likely to be the best option. Whereas if someone is not eligible for the pay as you earn plan, typically because they borrowed a long time ago, then those folks will have to give some consideration to that old or original income-based repayment plan, and they should compare that to the trade-offs available with the repay plan. Because those are almost certainly going to be the best options for that borrower. And so what all this means is that I don't like the new income-based repayment plan, and I think it is harmful and not the best choice for virtually every borrower. There's one sort of really unusual case where it could be useful, but for the most part, income-based repayment for new borrowers, the new income-based repayment, is a plan that should be avoided because the other options are better. And you can see here on this visual that income-based repayment for new borrowers and pay as you earn are virtually indistinguishable in terms of the way the payment is calculated, the way the forgiveness is accrued, the way income can be separated from a spouse's income. The only difference between these two plans is that pay as you earn has a cap on the amount of interest that can capitalize, and income-based repayment doesn't. And so if that's the only distinguishing feature between the plans, most borrowers who qualify for income-based repayment for new borrowers will also qualify for pay as you earn, because income-based repayment for new borrowers is only available for people who didn't have loans until after 2014. And pay as you earn is essentially just limited to people who didn't have loans before 2007. And so those are going to be the same people. If you didn't have loans before 2014, you also didn't have them before 2007, typically. Now, it's slightly more complicated than that, but that's what it boils down to. And finally, comparing the pay as you earn to the revised pay as you earn plan, because this is the evaluation that many borrowers have to make. If they're eligible for pay as you earn, there's almost no scenario where choosing income-based repayment would be better. So they should consider pay as you earn versus revised pay as you earn. And the focus of decision making needs to be on two factors. Under repay, people with graduate and professional degrees will have 5 more years until the maximum repayment term is reached. 25 years under repay, 20 years under pay. Also under repay, what can be a deal breaker for people is that if you're married, you're paying based on joint income, because it doesn't matter what you do with your taxes, you still have to make payments based on joint income. So there's no option to separate your income. And then you have those interest accrual versus interest sort of waiver provisions. So pay as you earn caps the amount of interest that can capitalize, but revised pay as you earn limits the amount of interest that actually accrues during periods of negative amortization. So that can be more valuable to some people. And so, what this kind of comes down to is that repay is less advantageous for married borrowers if they both have incomes, unless they both also have student loans. So if you're advising someone who has a lot of money in a lot of debt in student loans and is married to someone who also has a lot of student loans, then repay may be great and the whole joint income thing may not be a deal breaker. But those are the kinds of considerations that come up. So everybody can benefit from one of these plans at, under some circumstances. And then the last thing I will say before I'm looking forward to hearing Larry and his case studies so he can show us sort of how this plays out. But for those who don't qualify for pay as you earn, they will need to look at the original income-based repayment plan and compare that to revised pay as you earn. And it will be the treatment of married income and the payment calculation that makes the biggest difference. So repay will set payments at 10% of joint income, whereas old income-based repayment will set payments at 15% of either joint or separate income, depending on how the taxes are filed. So that's how to make those decisions. And that is the conclusion of my comments for this time, unless, Tom, you'd like me to take any questions before we turn it over to Larry.
Great, thank you, Heather. Actually, we will hold the questions until after Larry is done, but before I hand it over to Larry, actually, I will take the presentation privileges back and let me do that. But again, folks, we are going to launch two questions, again, two polling questions quickly here to make certain everyone is paying attention. So let me launch the next question, which is hopefully it will come up on your screen. Sorry, we're just there we go. All right, let me make sure. Hopefully everyone can see that. I actually don't see it in the normal form, but hopefully I see people participating. So again, I'm going to ask if you can quickly participate. Would like to try to move things along, but which of the IDR plans do not require evidence of a financial hardship? Hopefully everyone, again, if you don't see the pop-up window, you simply have to minimize the presentation screen. So apologies if that's an issue for you, but let me also, we're going to give it, all right, let's give it 5 more seconds and then we will close that. All right, here we go. And then I will share the results. Hopefully you can see that. And the correct answer was B, ICR and repay. And again, 53% of you had that right, or got that answer correct. And let me launch again one more polling question, excuse me. Which IDR plan is available for older FFEL loans? Again, 3 options there: old IBR only, or old and new IBR, or no IDR plans are available for the older FFEL loans. So again, let's give it 15 seconds and then we will move on to Larry here, and I will get the screen set up so that I can advance the slides here in a second. Larry, just bear with me until we get through the poll. And all right, folks, going to give it 5 more seconds. All right, here we go. And all right, the most popular answer was A, and that in fact is the correct answer. 63% of you voted A, the old IBR only. So, okay, Larry, give me 1 second, as I said. Let me bring this up. And then let me just kind of reintroduce Larry, and hopefully, Larry, you can see the screen okay, right?
Oh, yeah. Mm-hmm. Can you hear me okay, Tom?
Great. Yes, I can.
Okay.
Thank you. So, you know, Larry was kind enough. Larry actually is the founder of a firm that produces some really innovative, very unique financial planning software. Many of you listening may be aware, I'm sure, familiar with Larry and familiar with the program. It's called Maxify. There's a version that's available to financial professionals as well as consumers. And it's really unique in that it's built around some long-standing, important economic concepts. And we can have Larry kind of touch on that as part of the Q&A. But it's awesome financial planning software. I can say that I've used several different programs out there. So again, Larry was kind enough to create, working with Heather, some scenarios that contemplate various student loan situations, and kind enough to use Maxify to go through that. So with that in mind, Larry, I will hand it over to you and just let me know when to advance.
Great, Tom. It's a great pleasure to be with you and with Heather and all the participants. The student loans are really a tricky issue. I mean, Tom's exactly right. Heather's steeped in this, but it's really very complicated. It's up there with Social Security in terms of the details. So I just want to say a couple of general things as an economist about how to think about these options. One is, first of all, your eligibility for getting student aid for your child. By that, I mean grants and scholarships, not what they call student aid, namely loans. I mean, they call loans student aid, but I don't call that aid. That's a cost. But anyway, the grants and the scholarships, in order to get those, you basically have to show student need. There is the potential for a merit-based aid, but the calculation is going to start with the student's need. And if the parent has accumulated too much in the way of wealth and has too much income 2 years before they actually apply for aid, that's going to reduce their aid. So there's a big tax on college aid in the form of grants and scholarships, and that means that it can be this large. It could be that you earn an extra or save an extra dollar, and you end up losing 22 cents of aid for your child over the next 4 years. So that's a huge tax on saving. There's also like a 14% tax on earning. You earn another dollar this year, 2 years later, your kid gets an award that's 14 cents lower for that year. If you keep earning that extra dollar, then you're going to lose 14 cents each year. So there's a program that I came across called inmytuition.com. No, sorry, it's inmytuition.org, which an economist named Phil Levine at Brandeis developed. I just learned about this a couple weeks ago, and it works with about 70 different leading universities in the country, and you can go in there and very quickly see, hey, if I showed up with more money in my savings account, how much is it going to cost my kid? And if you put money into your retirement account, you can reduce this asset tax dramatically. So that's really, and also, of course, if you earn less income for whatever reason, or can, let's say, not take withdrawals from retirement accounts, so you have lower AGI 2 years before your kid is in school and through their college period, you can lower their need for, their net costs. If you lower the net costs, that can lower their requirement for borrowing. So that's why I was going into this, which is, let's start out with how do we lower the net cost, and then talk about the borrowing. So once you have, the kid in college or the grad student in college, or then we have all the options that Heather was laying out, depending on your history of interacting with these plans. And it is extremely, as I said, complicated. But let's look at the first slide. The economics approach would say, try and get as much aid as real aid as possible, make the cost as small as possible, so you need to borrow as small as possible. But then the key thing is to try and get the lowest interest rate as possible on these loans. So Tom, if you can show the first slide. Tom? Here we go. So this is based on a software program called Maxify.com, Maxify. And what it does is it takes in the standard inputs that any financial program would take in, but it also figures out the lifetime spending of the household. So we could be thinking about in a 20 or maybe somebody who's starting out at age 18 and they're going to earn a certain amount in college and after college in the career they're choosing. And then they have these loans which are treated in our program as special expenditures. And the different loans can be set up as different profiles. If I use this loan type, what does it mean for my lifetime spending, for my bottom line, my discretionary spending capacity? If I use this type, what does it mean for my lifetime spending capacity? So it gets all the taxes and also the loan repayments correct. It's not automated yet to take into account the loan, but if you figure out from the loan officer what the options are, you can just enter them as different alternative profiles in our program if you're running our program and see what the bottom line, because it's very hard otherwise to figure out what is more expensive than something else until you really look at this bottom line. So let's just look at an example here that I ran through the program. Sam Smith, he earned $65,000, 30 years old. He's got $200,000 in loans. You can say, well, gee, how did that happen? Well, maybe he went to Boston University that has $75,000 in tuition, and he's been borrowing a lot, both federally. I think the maximum for 4 years around $31,000. So he got some other loans, and he might even have had his parents borrow on his behalf, but he now owes his parents back under this Parent Plus. We don't know who the ultimate borrower is, so that's a very big concern I have. The kids are getting into more hock because their parents are putting them into hock, unless they have a real conversation that they're going to handle this. So anyway, he earns $65,000, he owes $200,000. He's got two loans, to make it simple. Both are $100,000. One's a 3% loan for 10 years. The other's a 6% loan for 20 years. So clearly the return you can get right now on long-term treasuries is around 1.5%. So paying 3% is bad enough. If you can only earn 1.5%, paying 6% is terrible. So maybe there's some value to switching this around. Could you, let's say, make the 20-year or 10-year loan and the 10-year or 20-year loan by, there's a couple ways you could do this. You could try and extend the 10-year loan, make it into an extended loan program. And then you could also you could either switch the 20-year loan into a standard, maybe 10-year loan, or I guess you can just prepay that loan more rapidly. But anyway, Tom, let's go to the next slide and we'll see what this idea of flipping the two loans means. Okay, so here's just to begin with the base plan for the household. Keeping the loans that they have, this guy Sam, keeping his current loans, gets to spend $1.857 million in lifetime spending from 30 through age 100 if he makes it to his maximum age of life. If he didn't have to borrow at all, if he had no loans whatsoever, he'd be up $247,000. So you can see that this cost of borrowing, this interest rate above the market rate, makes these loans more expensive than the principal. And the longer you have to pay off these high interest rate loans, the more expensive. So let's go to the next slide. And the next slide just flips the the terms of the two loans. So it makes the 3% loan, the 20-year loan, and the 6% loan, the 10-year loan, rather than vice versa. And this brings in an extra $23,000. It's not a huge amount of money, but it's certainly, if he's making $65,000 a year before tax, he's making $45,000 a year after tax. This is like a half a year's net income for Sam, so it's not trivial, so it's worth doing. Let's go to the next slide, Tom. So the next thing I wanted to do was look at a comparison of standard and income-driven repayment plans. So I'm looking at the new, or the revised payee plan, REPAYE. So we got Dave and Sally Fields. They're 27. Got two kids, 5 years old. Dave just graduated med school with $240,000 in loans. And this is quite typical of med students, that they could have huge amounts of loans. Now, for a share of them, a good chunk of them, they go off to work at a nonprofit hospital, and if they spend, I guess, around 10 years or so, they can then have their loan forgiven. So that's one way out, but they may get paid less as a result. Anyway, they got this $240,000, 6% rate. So Dave's going to, Sally doesn't work. Dave's going to do a 3-year residency, $60,000 a year, and then his subsequent salary will be $200,000 a year. So let's go to the next slide. And okay, so the lifetime discretionary spending under these two different ways of repaying, the base plan incorporates the standard 10-year repayment. The lifetime discretionary spending is the 20-year repayment. The 20-year, sorry, I'm comparing not yet the, I'm comparing 20-year repayment with 10-year repayment. The base plan is the standard 10-year repayment plan, and the other option is the 20-year extended repayment plan. So I haven't yet considered the REPAYE option. I'm coming to that in a second, but I wanted just to show you that the cost of these things are relatively similar. Well, not that close. I mean, there's about a $53,000 advantage of paying it off sooner. So that reinforces what I said before about wanting to pay high interest loans off sooner if you can. But let's go to the next slide, Tom. The big concern with both of these plans is that they don't leave Sam and his wife with enough money to spend when they're in the next 3 years, because you can see their discretionary spending, their living standard per adult, which is just taking their discretionary spending and dividing by 1.6, which deals with economies of shared living. They don't have a whole lot for discretionary spending. And then once he gets to his standard job, it jumps way up. So they're cash constrained quite severely, and clearly extending the loan helps, but it's coming at a cost of, what I said, around $53,000. So let's go to the next option, Tom. And the next option is going to this REPAYE plan, where you pay 10% of your salary, and he's going to pay it back within 20 years, the loan. So he's going to have, there's no forgiveness issue here, which might come up with certain people, but not in this case. And you can see that the costs are pretty much the same, but the slide that I should have added to this, but that corresponds to the one you just saw, showed that there's a significant improvement in the cash flow, because he's only paying 10% of around $60,000, because the repayment is connected to his AGI, and his AGI is low. So during these 3 years when he's in residency, this is helping with his cash flow problem. And so that might be worth it. And he also has the benefit of the of having to potentially get forgiveness. If he doesn't earn that much money, as much as he projects, then there'd be potentially failure to repay by 20 years, and then he can get out from under. So there's that advantage. On the other hand, if he earns more money, if he earns a small amount of money for a while and then a higher amount of money, then as Heather was indicating, this loan balance, which is kind of connected to the standard plan, it's going to keep accumulating. So there's kind of a bit of bookkeeping, and he has a bigger bill that he has to pay off. So it's not just taking 10% of his pay, but it's also increasing his balance. So in some way, this is a risk mitigating policy, but in some ways it's a risk increasing policy. So it's not at all clear that this has overall risk mitigation involved in it. Of course, upside risk, having more income, and then having a lot bigger loan balance. Well, that's bad. Bad thing happens in good times, so maybe it's not so bad. But on the other hand, you have to see exactly how much they're taking from you in good times to see whether this is really worth it. Tom, let's go to the next slide, which is what happens if his wife Sally goes to work. And now she goes and earns $100,000 a year, and because they're in the repay plan, her salary gets added to the AGI of the couple, and now she's having to pay 10% of her salary on his loan. So he marries her, and she marries not just Sam, but she marries his loan. So this to me seems quite awful, and it means for the couple that they're going to end up paying $200,000. So they're almost doubling the size of their loan just by being married. Now there are other plans that allow them to file separately as opposed to jointly, but they come with a higher share of your income that they extract. So these are complicated plans to evaluate. My last word is that the only way we can really see compare them, economically speaking, is based on what people get to spend over their lifetime in present value, but also annually looking at the cash flow issues. So I'll stop there, Tom, and take questions with Heather and you.
It's a great question from John. We'll start with that. Interesting. Should we be advising certain clients to not, in all capital letters, not try to pay off student loans since the Biden administration may do away with them? Heather, Larry, thoughts?
So my thought, Larry, is that, really right now is not the time to take all your life savings and pay off your federal student loans, or to refinance your federal loans with a private lender, even at a lower interest rate, because we should at least wait and see what happens here in the first days of the Biden administration. I think it is, and this, I've been gunning for various kinds of cancellation of debt and loan forgiveness for years. This is the first time I actually think there's a real possibility of some debt cancellation. I think it's extremely unlikely that it'll be the whole 50 grand that is proposed by Senators Warren and Schumer. I think that could only happen if, I think that's only likely to happen, or even possible to happen, if the Senate is in Democratic hands after tonight's Georgia runoff election. But I think that the Biden administration is very likely to cancel some debt. This whole idea of wiping away 10 grand, even in the absence of congressional action, I think is a real possibility. So yeah, I wouldn't advise anybody to be paying off their student loans, right now. I would say let's wait and see what's going on in February before we do that.
Yeah, I agree, and I wouldn't actually just spend the money. I would hold the money to the side so that if you need to pay it, and also don't do anything that puts you into arrears. I wouldn't say that's a good idea, because if you default on student debt, you get into financial hell. And if I were president, I would be letting people borrow at the Treasury rate, period. I think that's actually the best way going forward, but I'm not president. We'll see tonight or tomorrow.
Someday, Larry.
Yeah.
That reminds me of a good question. And by the way, folks, for those, and I see we've had some folks jump on and jump off, for those of you that have other appointments, understand, and you certainly satisfied any CE or CPE requirements for those of you listening in as a member. But that reminds me, Heather, if in fact the relief is extended through the end of March, I think you said in your opening comments, does it make sense for folks to continue, those that have the means, to continue to make payments, try to pay down that principal, even if the interest rate is zero? What are your thoughts on that?
Yes, it definitely makes sense for some borrowers. I think the way to determine how to direct funds towards student debt right now is to start with a really clear inventory of the student loans. So to the extent that there's any private student loans outstanding, I would often prioritize repayment of those, even if they're at slightly lower interest rates, because of the consumer protections that come with federal student loans. I would also say that there are many borrowers that have unpaid accrued interest outstanding on their accounts, especially those that are enrolled in income-driven plans. So the first thing an advisor should do is evaluate whether or not there is any interest outstanding. Because if I send money to my student loans right now, it will be attributed first and exclusively to my outstanding interest balance, and it will not reduce the principal balance of my loan unless or until I fully repay all the outstanding interest. So, but yes, Tom, if someone has no outstanding interest or is able to fully repay the outstanding interest and reduce the principal, this is a pretty unique opportunity to bring that principal down. And so if there's very little likelihood of forgiveness or cancellation for a given borrower, I think that can be quite smart to do. But alternatively, as Larry's saying, if someone has the discipline to just hold on to the money in a safe place, there's no real benefit to paying the loan right now because it's not accruing any interest. You can hold the money in your own account until that interest starts to accrue again and then send it at that moment.
Okay, great. All right, next from Jolene. Jolene, good to see you on. And Jolene, I'll relay this question, though we might need a little clarification. Jolene has a client that is a teacher, is on an IDR plan. She is filing married, filing separate and versus jointly, and says this allows her to have her entire student loan be $0. I'm assuming zero monthly payment. She has 3 children. Is this really possible that they don't take into account the spouse's income if filing married, filing separate? Does that make sense, Heather?
Yeah, that makes perfect sense. And in fact, that does occur with these income-driven plans. So if a person with 3 children and a spouse, because you get to count your spouse and your family size even if you file separately. So that's like the example I gave at the beginning. 150% of the poverty rate is 46,000. So a person, an individual, this client, this married client who's filing separately, could have separate income of 46 grand before any payment was required. And as a teacher, if her payment is calculated at 0, so she's paying 0, that can still count as a payment towards the 120 required for public service loan forgiveness. So in her role as a teacher, you have to make 120 payments towards forgiveness. But if your calculated payment is 0, then you can be credited for times in which no payment is required.
Wow, that's amazing. All right, great. And we do have another question. We'll come to that in a few minutes with another scenario that's pretty similar with the teacher. But next from Victoria, if not married but living together, does the other spouse's income, is that also included? So Heather, if you could, please.
It's not. It's not. So you can be living in a household with all sorts of earning people. And if it's not a married person, like even for example, if an adult child was living with their parents and was financially dependent within that household, that adult child with student loans wouldn't have to count their parents' income, even if they were being supported by their parent. It's only a spouse and only when you file a joint return under most of those plans, except repay.
Okay, great. By the way, between that and Larry's last example with Dave, and I forget the young lady's name in that example, it makes me think that not getting married might be an optimal strategy. And that's hard for me to acknowledge because I'm a traditional thinking guy, but hey, be that as it may. All right, next from Vicky. Yeah, right. I know. So from Vicky, if a student has chosen
Tom,
a plan, sure.
I just want to add one little thing to that, which is if you're in a plan that's taking 20% of your salary and you've got to pay for an au pair, or somebody to take care of your kids to daycare, and you've got to pay federal and state income taxes, you may find out that all these things together, you're worse off than not working.
Yeah,
that sounds
right. I mean, you're right. Your last example, no question. I think you have to weigh that very carefully. No question. Good point. Okay. Next from Vicky, if a student has chosen a plan after graduating but hasn't yet started making payments, can they choose a different plan?
Yes, you can switch repayment plans anytime you want into any other plan that you are eligible to choose. So the only time that you can't, the only limitations to what plans you can choose or how often you can switch would be if you are in a default status on the student loans, or if you are enrolled more than half time in school, you can't have your loans in a repayment status, so you can't select any plan. But yes, you can change repayment plans when you want to.
So to follow up on that.
But the important thing there is
Go
to keep in mind the other point that Heather was making, which is that when you switch plans, that's an opportunity for the federal government to recapitalize your loan. So if you had been, let's say, paying less than the standard plan would say, and now the standard plan's balance has been going up, and you've been accumulating this interest that's gone unpaid, and now you switch to the standard plan or to an extended plan or to even a consolidated plan, all of a sudden your principal is going to go up. Now they're going to charge interest on the interest, in effect, because they're going to add interest to the principal and and charge interest anew on that bigger balance. So that's the capitalization concern that Heather's raising, interest on interest compounding through this mechanism. So you've got to be careful about switching plans and seeing if there's ways to pay off, like the longer term loan, for example, just prepay it rather than, the higher interest rate plan, prepay it rather than switch it potentially. I get it?
Yeah, that's a great.
I learned my lesson yesterday. Heather and I were on the phone for half an hour on this stuff.
You're making me so proud, Larry. And it's not every day that one can teach something to a renowned professor of economics, So I just like to give myself a hand,
Well, you're getting an honorary degree at the end of this. Okay, thank you.
Well, okay, and I won't. All I'll say is I'm hoping to be hired as someone's research assistant someday, because I'm on the phone with Larry Saturday afternoon at 3:00, kind of bouncing these ideas around, right? So I thought, oh gosh, I see my future now. So with that in mind, so this is kind of just to kind of reaffirm that, Heather, like what Larry and I were talking about on Saturday, and for everyone listening, hopefully you find value in this narrative or conversation. If a young person graduated, let's say in what year, 2020, came out, had a job, or let's make it 2019, was working a little bit, was in a standard repayment plan, then lost their job, unfortunately, which unfortunately all too many kids did last year, young people did last year. Could they then go on an income-driven plan only? And I'm sorry, there's one more leg to this, Heather. Only to have the possibility of, let's say, they went on that income-driven plan now, but if they were hired at, let's say, Google or Facebook or some employer where they made $100,000 a year from now, would they then have the option to go back to a standard repayment plan? So they start at standard repayment, go to income-based, and then go back to standard repayment. Is that all feasible?
It is, Tom, but it's important to recognize what Larry was pointing out about switching repayment plans having sometimes these negative consequences. So, and I'd also I think what I'd really like to do is emphasize the relative unimportance of switching plans. What is the harder decision is how much to pay. So I see, Tom, your hypothetical as including a situation where someone is earning relatively low amount of money for a while, enrolls in the income-driven plan to have payment relief so that the monthly payments are affordable and cash flow still works. Then they start making money at Google. So what should they do? Well, Tom's question implies his knowledge that they should start paying more towards their student loans because they're able to afford to do so. And I agree with that. But you don't have to switch to a standard plan in order to do that. You can always pay more than what is due. You can make extra payments. You can round up. You can prepay with no penalty. And so switching back to a standard plan is of very limited use. In fact, it then it eliminates the possibility of debt cancellation if this person gets fired from Google later, or, God
Right.
forbid, becomes unable to work or something. So the income-driven plans are helpful for reasons in addition to the fact that they allow for lower monthly payments than a standard plan. And in fact, the payment is capped, right, under many of those plans, Tom, so that borrower, if they start working at Google, would see their payment go up under the income-driven plan, but it wouldn't go up past where it would have been under a standard 10-year plan. So they're better off staying in the income-driven plan, paying the amount they would have paid under a standard 10-year plan, but not switching to that plan.
But Heather, let me just double check on something.
Yeah.
If they hadn't paid for, let's say, a couple of years because they lost their job, their balance is going to be pushed back up, so they're going to pay more. It's true they're not going to pay more relative to the standard plan based on the new balance, but they will pay more compared to the initial standard plan they were on with the initial balance.
So that is true. So certainly that's exactly right, Larry. So what Larry's pointing out to us is that a person who earns more money over time might look back and say, gosh, I wish I had paid more aggressively at the beginning of my term when I was in an income-driven plan. So I certainly agree that people should not only pay the minimum required under an income-driven plan or otherwise, unless they need to or they have other higher priorities for what to do with their cash flow that they have, which is often the case, right? Because federal student loans are relatively affordable. Their interest rates aren't great, but they're, not terrible compared to like credit cards and things. And so, you can regret paying the minimum possible monthly payment amount, but it's not to blame the income-driven plan for that, in my view. Like, it's to blame the amount.
One last important thing, which is that on the repay, there's no ceiling on the repayment, right?
Right, that is true. And that's a risk to that plan, because you could have very high payments potentially under repay. But and some people think that's a feature, right? They think it's a feature because if you do start earning more money, you should be paying more in most cases. That's often the better thing to do, but that plan would require you to do so. So you're right, Larry. I think that's an example where a person in an income-driven plan maybe should switch back to a standard plan, but you only benefit from switching to the standard plan if your payment's lower than it would have been under an income-driven plan, not higher. Because you could always pay more. You don't have to switch in order to pay more.
So Heather, I know you like the calculator from the simulator from the VIN Foundation. Does that? I've played with that a little bit. Does that allow you to model like the prepayment scenarios like we were just touching on, or not so much?
Not really. I can kind of manhandle it into doing a few things. Like what I would do in a scenario like you're talking about is start out with the balances and the interest rates and the income and the income-driven plans and see where that goes. And then if you want to do a scenario where you say, okay, what if the income jumps at this point and then you start paying more? Just evaluate what the balance is at that moment in time and then start a new simulation from that point forward. And that's really the only way you can do those extra payments for that tool right now.
Okay. And for folks listening, again, there's we will make sure we publish this as part of the replay, a link. We're actually going to put a summary together for today's session with some of the highlights. Should have that out in a few days that we post along with the replay. And again, we'll have some links to these various resources. There's a pretty neat calculator that's put out there by a foundation that serves vets, young folks that are going through veterinary school. And then also the federal folks, there's a federal loan simulator. I've tried to look at that, Heather. I don't know, again, if you think that's not so much worth. Okay, there we go. That's all we need to know. All right. Okay, let's continue on with questions. Next from Lynn, and then Heather, let me know how much time you have because we still have a lot of questions, but please let me know what time you have. So next from Lynn, what happens if you file MFS, married filing, separately, and then do an amended return later, change into joint because the tax cost was too much for married filing? because the tax cost was too much better, I'm sorry, from Lynn for the married filing jointly. Does that question make sense, Heather? I hope that makes sense to you.
Yeah, it does. So it's a little sneaky, but I don't see anything in the law that prohibits it directly. So you file a separate tax return, you submit your separate tax return as evidence of your income in order to have your monthly payment established for that year, for the income-driven repayment plan. Then you file an amended tax return so that you can get the benefits of filing jointly. It's obviously it's getting around the, it is a loophole to sort of get around the spirit of the law, but it isn't prohibited by anything that I'm aware of. Interestingly, though, we should point out that you're not allowed to amend a tax filing from joint to separate as a married person. That's not permitted by the tax code. So if you get clients this time of year in your practice who have student loan issues, the first thing you should tell them is hold off on filing your taxes until we evaluate which way you should do it. Because if they file jointly, you can't do anything to fix that.
You just reminded me, and geez, I wanted to mention this up front. Heather's partner in the good cause, Jance Hoffman, they have worked together to create a whole designation, the Certified Student Loan Professional. Did I get that right? CSLP. And really that's a whole curriculum. I've had Jance on as well, Jance and Heather, just amazing stuff. And so again, if you're looking for a resource or expertise, there are a few hundred people, I believe, that have that designation in various parts of the country. CSLP, again, I'll put out the website for that. But Jance, just like Heather, is awesome and really just has put a bunch of great education together out there for professionals that can really help clients navigate through these complicated issues. So the tax perspective reminded me of that, Heather, so thank you. All right, next from Mike, actually has two questions. I'm going to combine these. One, why have two borrowing dates for eligibility for pay? And then also, let me just walk through a scenario. Mike has a public school teacher client who, before she became a client, was struggling with debt. She consolidated her student loans and did not know about the possibility of qualifying for the public service loan forgiveness. I don't think this is possible, but I'll ask anyway. Can she undo her consolidation and reset her payment plan to an IDR in order to qualify for PSLF? So there you go. So two from Mike. Again, the borrowing dates, why don't we start with that, Heather? Why two borrowing dates for eligibility for pay?
So that's an interesting one. So income-based repayment was established by Congress, and it's supposed to be Congress that makes laws, as you may recall from your early civics classes, right? We've got the three branches of government. There was some lack of action on the part of Congress, and so President Obama, during his administration, announced the pay-as-you-earn repayment plan and said that he was going to lower student loan payments from the 15% of discretionary income that was set out by the original income-based repayment plan, the old plan, that he was going to lower those payments to 10% of discretionary income, as Congress had already contemplated doing with an amendment to IBR, but that had not yet taken effect. So he was essentially fast-tracking this reduction in the required payment amount using regulatory authority that is authorized by the Higher Education Act. So it was an executive action. And I'm getting to the answer to Mike's question about why two dates. So it's 2012, and President Obama is campaigning for re-election and is literally on a college campus at the University of Iowa in the year 2012. And he was speaking to a group of undergraduate students who were gathered there. And he said to the group of undergrads, I'm going to lower your student loan payments. I'm going to make this happen for you. So then he gets back to Washington, and the Department of Education people say, like, okay, that's great, Mr. President, but we don't have any budget for this because Congress has not acted. And so we still have the same appropriations we've always had. So how are we going to lower payments for student loan borrowers? And they determined that they needed to narrow the category of people who were eligible for lower payments. And in determining how to narrow the category of people, they wanted to make those folk who were in the audience that day eligible because the president had promised them they would be eligible. And they were undergraduate students in 2012. And that's why, Mike, there's that second requirement that says you have to have a loan from after October 1st, 2011. Because if you were a senior at the University of Iowa in 2012, you were borrowing in 2012, and you didn't stop borrowing in 2011. And so what they wanted to do was cut off me and everybody else who had already stopped borrowing by that time so that they could afford to reduce payments for the other cohort of borrowers. So it's all about narrowing the people who were eligible for pay as you earn. And the second part of the question had to do with consolidating and public service loan forgiveness. So I think Mike might be referring to refinancing the federal student loans with a private company. If you do that, you can't undo it. You can't make them federal loans again. You can't be eligible for public service loan forgiveness. But there's a consolidation loan that is a federal student loan, a federal direct consolidation loan, which could have repaid other federal student loans. And direct consolidation loans are eligible for forgiveness. So she wouldn't have to undo it. She could keep it and just enroll in income-driven repayment on the consolidation loan and earn forgiveness of that loan if it is in fact a federal consolidation loan. So that would be the question is, did she refinance into the private sector or did she consolidate within the federal system?
Okay, great. Larry, if you could once again give us that website. We've had several folks asking about the
Sure.
website
Yeah,
that you mentioned.
It's maxify.com, maxify.com. Is that, oh, you meant the other one?
I meant the other one from the Brandeis, please.
Oh, yeah, that's yeah, Phil Levine. It's myintuition.com. Sorry, .org. I keep saying .com. It's .org. myintuition.org.
myintuition.org. Okay.
Yeah.
If I may just, I think one sort of relevant question for everybody is, you know, how do all these student loan repayment plans affect the ability of the borrowers to purchase a home? I think that's a question that probably is on the minds of many.
Well, this has to do with having a complete full lifetime plan that has all your cash flows, because if you need to put down a down payment, you know, like in our software, you can say, okay, in 5 years, I'm going to buy a house with this type down payment and this mortgage. Then you're going to see that if you pay off your loan rather rapidly, rather than over an extended period of time, you're going to be in much worse cash flow shape. So, you know, definitely buying a house is a good thing for sure. It's a safe asset because if you're sitting in that, the price can go up and down. You still have the same housing services from that house, so it's a very safe thing, especially when you're older, to get into a housing or an apartment, a condo that you own. But yeah, you have to see the whole cash flow story as well as the level of spending over your lifetime.
I'll just add to what Larry said. I certainly agree with everything Larry just said. And I would also say that, you know, student loans from a credit reporting aspect are treated as installment loans. So they're not like revolving credit, like a credit card. So it isn't as important what your balance is as it is what your monthly required payments are. So the lenders, when they evaluate debt to income ratio in order to assess, you know, their kind of opinion of the prospective borrower, including for mortgages, they consider the required monthly payment. And many borrowers find it difficult to convince the mortgage lenders what their payments are under an income-driven plan. Some mortgage lenders will assume you're required to pay 1% of your principal balance, which makes sense under a term repayment, but doesn't make sense under an income-driven repayment. So people have to get official letters from their loan servicers that indicate what their required monthly payment is, and often have to be more hands-on with the underwriter in terms of establishing, you know, what they're actually required to pay on the monthly. And student loans can, in fact, help people build good credit over time if they make on-time payments over a period of time, or the opposite. If they're late in their payments and they have a bad history with student loans, that can affect their ability to borrow at good rates after that. So those are the essential ways that it factors in, but mostly just in a monthly cash flow type of aspect of what you could afford on your mortgage payment.
Okay, great. One last question from Cindy, if I may,
Sure.
and that is, she has a client who works for a municipality, was on a plan to have the loans forgiven after 10 years of payment. He has 8 years of qualified payments so far, but will struggle, to restart paying the full amount in February, assuming that's our restart date. What options does he have?
Okay, so what I understood was that this is a person who's on track for public service loan forgiveness, has been making payments,
Correct.
getting credit for those payments, and so during the period of what I'm not sure I understood from the question, Tom, is this person still employed in this public service job? Did they have a reduction in their income?
Yeah, that's a great follow-up.
Because
So,
I'm
Cindy, if you
wondering
want
if
to.
she talks. So Cindy's saying that this person's going to struggle to make the payments again. So they could update their income information with the student loan servicer so that their payment amount could be recalculated. Now, if they're struggling because they don't have their public service job anymore, then so they can postpone making payments entirely. Just, if they've lost their job, you just update your income and say, I'm not making any money, I can't pay anything. And they say, you're right, you can't. Your payment is now zero. That doesn't wipe away the progress towards public service loan forgiveness, but it also doesn't continue to progress him towards the 120 payments. So he'd have to go back and be employed in public service again in order to complete that.
So absent everything, it's a great point, Heather. Good reminder. One of the things I've learned in the last couple of weeks is, there's an annual certification that's involved for these income-driven repayment plans. But if your circumstances change at any point in time, guess what? You should reach out to your loan servicer if you have any issues like this or a change in circumstances, and look to do that certification mid-year or whatever, right now if you have these issues. But make sure you press your loan servicer to present any and all options that are available to you. That's, again, one of the things that I've learned from all the research and listening to you, Heather. So
that's right,
Tom. A great point.
Let me plug your coming webinar. When I heard Tom say that he was having Joe Messenger on and College Age Pro, I do want to say Joe Messenger is really smart. College Aid Pro is really great. And if every family went through their pre-qualification, I think they call it, I would be out of work, right? Because none of us would need any student loans, anymore. So I really like Joe's way of thinking about things and way of presenting things. So I certainly really encourage folks to attend that because I guarantee it'll be chock full of really important information.
Heather, so great to have you again. And I am so thankful. Everyone is so thankful and really excited for brighter prospects ahead for you and for everyone this year. So thank you so much.
Thanks again. Have a great one. Thanks, everybody. I'll look forward to staying in touch.
Okay, wonderful. Thanks, Heather. Thanks, everyone, for joining. And as always, if you have any questions or I can be of any help, feel free to drop me an email, tom@financialexpertsnetwork.com.